Good evening, everybody. Welcome to the Raisin webinar. My name is Kevin Mountford. I'm the co-founder of Raisin UK, which launched here in the UK back in the summer of 2018. So it's been an interesting 6 years, and pleased to say that for most of it, it's been real fun. And thank you very much, as I say, for joining us and obviously being customers of Raisin. I'm going to be joined this evening by a couple of my colleagues. So we've got Jasmin, Ehlert, who is head of banking analytics, and we've got Robyn Demming, who is the senior relationship manager. We've had lots of interest in terms of people registering, and also a big thank you to those who've sent some questions through. So effectively, in terms of the outline agenda over the next 30 minutes or so, you're going to have a presentation. It's going to be looking at market trends, and then we're going to start looking about the impact of interest rates and what it really means for our banking partners and the kind of products that they're going to be offering you in the weeks and months to come. As I say, we've had lots of questions, so at the end of the presentation, the aim is that we'll start to kind of deep dive into some of those questions, and there are some common themes, but hopefully we can get through most, if not all. And as I'm sure you're aware, today there was a budget. So if there's anything relevant coming out of that we think could affect you as savers, then no doubt we can touch on that. But I think in summary, there was very little. So without further ado, let me pass over to Jasmin, and we'll start with our presentation. I should also add that, sorry, this is being recorded.
Thank you very much, Kevin. So tonight, I would like to review with you the current interest rate environment, as Kevin has just introduced, and kind of look at the impact that the monetary policy of the Bank of England has had and still has, of course. So first, let's look at capital market yields. These are an important indicator for market sentiment, which is quite important when we're talking about rates and the current savings market environment. So you see here that up until August, we actually saw the yield on 2-year government bonds fall across the region. So here we're looking at the US, we're looking at Germany and the UK. Why did these bond yields fall? Because investors increasingly were expecting quicker cuts to the bank rate. And these bonds are typically a really good indicator of market expectations for central bank key interest rate developments. So given this downward trend that you see very well on the slide, the lines are moving down, it is clear that investors' confidence in upcoming rate cuts increased in spring and summer, and that's why these yields fell. We have now seen yields increase again in the past weeks due to signals that the Bank of England might not cut as quickly or as aggressively as initially expected. So the question is now, so what influences these investor expectations and therefore bond yields? So one of the key factors is the inflation development. So as you can see here, inflation rates, they finally approached 2% this summer. 2% is the inflation target that the central bank is pursuing, that actually all of these central banks are pursuing. And after a small uptick in August, though, the September data, which came out really freshly, has shown that inflation has now fallen again below the Bank of England target. So dropping to 1.7%, it's actually the lowest we've had in 3 years. And you also see inflation falling on the other big economies, so quite good news if you're looking to do some shopping now. So the Bank of England responded to these positive developments in their fight against inflation, which is, of course, one of their mandates, by cutting the bank rates for the first time this year, last August. So after a period of unmoving high rates that you can see here very clearly in this chart. So the question is that we're asking ourselves, that banks are asking ourselves, that maybe you're asking yourself, what comes next? So we saw on this first slide that the expectations currently for the rate cuts, according to these yields that we look at, are for the Bank of England to move much more carefully going forward, also compared to other central banks. The reason for that is that the British economy is actually still performing relatively well. Better than the Eurozone, for example. And we'll see also more government investment. And those are two factors that kind of mean that cutting rates quickly to try to give a push to the economy is actually not that urgent. The economy is doing well enough, even though inflation has fallen, it's not given a very strong incentive to move very quickly and very kind of abruptly for the Bank of England. Nonetheless, so we still expect the Bank of England to gradually lower rates over the coming year. And you see this here, how the line, the dark part of this, the forecast is slowly moving down. And we will certainly most likely see a rate cut also at the next Bank of England meeting in November. So these additional cuts are likely to continue through 2024. But there is still no broad consensus on how low rates will ultimately go. So our current estimate is for a bank rate level of about 3.5% by the end of 2025. Now, this is kind of the wider market. I think you're probably most interested in what does that mean for bond rates, for deposit rates. So here we're looking at the top rate development for the deposits that you can access on the UK market. So what you don't see here is at the end of last year, we actually saw on the UK deposit markets that banks already reduced their rates for easy access and fixed term deposits in anticipation of rate cuts. So they thought the Bank of England was going to cut quite quickly. In the end, that didn't materialize as quickly. So the situation stabilized. And you see this here very clearly. You see those lines are quite flat. The rates barely moved much up or down. And then you see a notable decline in top fixed term deposit rates in August. This is, of course, when the Bank of England finally cut the rate and then banks pass this on directly to customers. And we expect kind of this downward movement that you see here, this kind of zigzag shape to happen as well at the next Bank of England cuts. So you can expect also with the Bank of England expected to cut rates in November, to also banks passing that on, and for these rates to top rates on the market in general, rates on the market to also fall for the products that you can access for retail deposit products, for bonds, and so forth. So of course at Raisin, we have also a view on this, and actually looking at the Raisin platform, the trend is also quite clear. So what you can see in this chart is the number of rate cuts and rate increases amongst our partner banks. And you see here, the number of rate cuts and increases is quite stable. And then you see a very marked increase in the number of rate cuts that we have in August. And that's, of course, driven by the Bank of England cutting rates and then banks reacting quite quickly and cutting rates on the products also on our platform, on the wider market. This is really something that we see everywhere. And it's not just kind of special to Raisin. So to summarize, we do see a downward trend in fixed term deposit rates, also with the upcoming rate cuts. Now, to showcase again how this has moved and where we stand right now, you see here how the rate level, the average of the top 5 interest rate on the whole UK market has developed over time in the last few months. And you see how the rates have fallen. So what we expect next, not only that the rates fall, but we expect to see the largest rate cuts, particularly in the shorter term. The longer terms have already priced in kind of the expectations for rate cuts more strongly. You see here on the slide that rates are much lower for the multiple year fixed rate bonds. And so rates in these areas will also continue to decline, but the shorter end is expected to be impacted more. So as a result, we will see a normalization of the yield curve in the coming months. As shown here, this is what the yield curve looks like. So it's expected that the shorter terms will have lower rates than the longer terms at some point in the future. So currently, we still have an inverted curve. So the slope is kind of, the line is sloping down. The highest rates are found in the shorter term. And the normalized curve, which we'll reach in the next months, is for the longer term deposits to reward with higher interest rates than the shorter terms. So that's the view now. That's it on market dynamics for me. And I'll hand over to you, Robyn. So what does that actually mean for saving products?
Thanks, Jasmin. So after talking about what's happening in the market, it's a great time to show you what our top offers are on raisin.co.uk. So as our customers, you can access these on our site and also on our app. And then we also often highlight our top offers in the newsletter as well. So looking at these top rates, we did notice there was a little bit of a theme with some of the questions. So one of the themes was, what is the best type of saving account, a short-term or a long-term fixed rate deposit? So based on the future predictions for the Bank of England rate in Jasmin's earlier slide, the rate could be around 4% by March next year, which typically means saving rates will decrease around this rate as well. So therefore, if you're able to lock in longer fixed term, you're more likely to get a stronger return on your investment now than next year when your shorter term it was to come to maturity. So rates then may not be as high as they are now. So I think the narrative is to lock in at the rates now while you can, while they're high. Now kind of moving on to our partners, we continue to add a range to our marketplace. This year we've added 8 new partners, and we continue to have a healthy pipeline of new banks joining the marketplace as well. So this is in order to give you access to a whole range of different types of partners that you might not necessarily see on the high street. We now have conventional banks, building societies, challenger banks, credit unions, and also Sharia banks as well. So you might not be as familiar with some of these names, but this leads me nicely onto one of the benefits of Raisin. So Raisin deposits are protected, so this can give you peace of mind. So Raisin only works with partners that are protected by FSCS or the equivalent European scheme. The FSCS pays compensation up to a limit of 85,000 per person per authorised financial institute or banking group, which is great because all the banks and building societies featured on Raisin UK are separate and individual entities. So what we mean by this is we don't have 2 or more banks within the same banking group. So as a customer, you're able to actually spread your money up to 85,000 throughout the different banks and building societies that we have on Raisin UK. So now in terms of where to actually place your deposits, it moves us nicely on to the Raisin app, which you can manage your money on the go. So this is also similar to what you might already have with your existing bank. It's an easy way for you to apply and fund new saving accounts in just a few clicks and view everything in one place for your account activity. You can also be the first to find out on rate increases and latest offers. We often do push notifications when we do have new products or latest offers as well. You can see all your renewal options for your maturing saving accounts and then actually renew within the app, making it very, very simple to still carry on getting the best savings for your money. When you do apply for your products, you can view the documents in your mailbox. And if you do have any questions, you can contact our customer services via the secure messaging system within the app as well. So if you don't already have the app, we have provided the QR code in the corner. So please feel free to download it. Or if not, you want to do it later, you can obviously search it within your own app store as well.
Thanks very much, Jasmin and Robyn. So let's we've summarised some of the questions on the slides, which we can talk through, and then just prior to us going live this evening, I've been shared quite a number of other questions. So you've all been quite busy sending those through during the evening. So we'll pick some of those up as well. A lot of people are very much interested in the outlook, really, and what we've seen is quite an attraction towards short-term bonds, particularly where people have been saving up for an event. And we've seen through our own research that quite a number of people are saving up for holidays and even Christmas, which is getting closer and closer by the day. So just in the first one, there's a lot of people asking whether they're better on short-term fixed or longer term. So Robyn, what do you think from the kind of products that we're seeing? And then Jasmin, if you want to add into that in terms of the points you made about the kind of interest rate outlook and why we see a difference in shorter term products and certainly variable rate as opposed to longer term bonds.
Yeah, happy to. So it's something that I think I touched upon also earlier. So the reason why we see this inverted curve, which is why we see kind of higher rates on the shorter end and lower rates on the longer end. So the reason for that, again, is the bank's expectations for the Bank of England rate. So in a falling rate environment, the banks expect the rates to be much lower in, say, 2-3 years' time. And then they already price that in, and therefore they have already lowered those rates much more strongly than in the shorter term. So the expectation is that we will see the situation normalize over time. The normal view, of course, the natural view would be that you would get a higher interest for locking away your money for longer. So we will get there at some point. It will take a couple of months, but that's certainly the direction we're going forward. I personally think, and Robyn, feel free to add to that, that even though rates are currently higher in the longer end, I think it's something that you already mentioned. So it does make sense to go for these products if you have some money that you're able to lock away for a bit longer, so you can kind of lock in the currently still very high rates. So of course they're falling, but they're now the highest I think they will be in the next years for sure. So you might want to lock this in, get that rate guarantee for a bit longer, because yeah, on the shorter end, of course, it's if you only have it for a few months, it makes a lot of sense, but you might have to reinvest at a lower rate.
Yeah, totally agree, Jasmin.
And I think we've seen, certainly for individuals who've got a little bit more money and the ability to kind of flex, that they're taking out a range of deposits. So as you say, you start to hedge against future interest rate reductions. The next question's about the budget, and clearly we've heard a lot today, and no doubt it's going to take time for people to invest, to digest everything. I know there was certainly a decision to abolish the British ISA, which was only introduced by Jeremy Hunt recently. The other thing, I saw that pensions, unused pensions, will come into scope for inheritance tax, and that'll be quite interesting to see how people start behaving to kind of minimise inheritance tax going forward, and maybe you see an increase in gifting of cash. I don't know if either of you have picked up anything else, but I don't think there was too much in terms of specific savings related issues, and there were fears that there could be impacts on things like the interest allowance, etc., on savings, but thankfully that hasn't been the case. So picking up on the question about short term and longer term fixed, the next question really then is trying to get some views on the balance of fixed and variable rates, and what we're seeing from maybe the behaviour of some of our customers, and I guess also from the changes we're seeing from our various partners and products are launching. So Robyn, any thoughts on this?
Yeah, so in terms of balances, I think there is a bit of a mix, and it's good that Raisin obviously offers a mixture of different products. So as we mentioned, you can kind of spread your wealth between the fixed and variable products at the moment. I think it really depends on your own personal circumstances, what works out better. I think you've got to understand what you need access to quickly and what things that you're able to kind of leave in the fixed term products. So obviously with variable, you have that flexibility of being able to access your money as and when you need to, whereas fixed, although you'll get a maybe higher rate, you obviously cannot take out those funds at any point. So really the balance between what to hold in which depends on your own personal circumstances. But I don't know if there's anything further, Jasmin, that you would add to this point.
No, I fully agree. I think, as with any investment decision, I think you should always think about how much do you need now, how much can you lock away, and I think that's a bit the balance that you can then also pursue when looking at bonds and at deposits.
And I guess continuing on that theme, the next question is a good time to switch to fixed. And I think as part of kind of answering this question, also going back to some of the things you presented, Jasmin, in terms of the outlook, generally speaking, people believe that longer term deposits pay a higher interest rate than short term. But because of where we are in the interest rate cycle, that's not the case. But I suppose the question is, are you better off locking in long term and getting certainty? So do you want to pick up on either of you on this question about timing to switch to fixed and the balance between short fixed and longer term?
Yeah, I think it's yeah, a mixture of what we already said. So now is definitely, so again, the rates are going to decrease. So I think now is as good a time as ever to kind of lock in the rates and go for the longer term with as much as you have, of course, which you're able to put away. I think the balance, it's hard to give a recommendation. Everyone's financial situation is, of course, very different. So I wouldn't want to give one indication across. I think, you attendees basically know best how much you need right now, how much you're able to put away for, let's say, a couple of years. I would say it does make sense to think a bit more long term, to not look, especially only go for the highest rate. Think about the rate development. We looked at this now already. Rates are going to go down. I think one of the strategies that people could pursue is kind of like a ladder strategy. So kind of divide your savings into different chunks, put some of it in the longer term, put some of it in the midterm, some of it, let's say, into a variable rate. And therefore, you always have a portion that will pay along high interest for a longer time, but you always have access to your money for a certain time, and you'll be quite well off.
One of the questions we'll come on to the inflationary beating question, but just in terms of products, as Robyn said earlier, we're offering a range of fixed term deposits and easy access. We also offer notice accounts. And one question came in: how far do you think notice savings accounts could drop in line with interest rate changes? And I guess, Robyn, what's the general view from the providers we work with? Because clearly notice accounts work well. They're very sticky from a deposit point of view. I quite like them, and I've been around long enough to remember when they tended to be the most popular products. But some of the research we've recently carried out, concern with some savers is the tendency to dip into the accounts. So they're not building up the pot they'd like to. For me, notice accounts take a bit more disciplined approach because you have to be a bit more considered to serve the notice. But what are you seeing generally from notice accounts amongst our partners, Robyn?
Yeah, we definitely have now a good range of term notice accounts. So we have even a 7-day notice account, 7-day ranging to 120-day. So this can be a good alternative to easy access. So, you still have maybe a short time period, but you do, as Kevin said, you do have to factor this in when you do need the money to allow that time to give notice to the partner that you need the funds back. There's a mix, but typically with notice accounts, you will see them kind of as similar pricing to easy access, if not better. I think that's obviously the attractiveness of it. So by holding it for longer and having that notice account period, you might actually get a higher interest rate than some of the easy access accounts that are out there. So this is some of the benefits, because if you can basically afford to wait a week, a month, then potentially you're going to benefit from a better return on your investment by having a notice account. So it's a good in-between option from easy access and fixed to have a notice account. So worth having a look at. We definitely have a big range of notice accounts now.
So, I mean, the last point on this slide is very much around savings of finally beating inflation. So we're getting a positive return on our cash, which is great. But you talked, Jasmin, about the outlook for inflation and the impact that that's had from central banks. We can always debate whether central banks have acted quick enough and have gone far enough, but we are where we are. But how long do you envisage that, based on the kind of data that we have, that savings will continue to outpace inflation in the UK, but also across other markets we're operating in?
Mm-hmm. Yeah, so of course we only have data. We don't have a crystal ball, so I can just tell you kind of what we can see and what we believe based on what we have. So on our end, we see actually the state that we have currently, where you get a higher interest rate than actually the inflation that we have, to hold for the short to midterm future. So rates will of course fall, but the spread to the inflation, so the gap that you have between inflation and kind of the deposit rates and the bank rates, that will stay there for at least 2 years is what we expect. From then on, the outlook is of course much more difficult. A lot can change, but that's currently what we believe based on the economic data, and also the rather slow pace that is currently expected for the Bank of England bank rate cut. So that's of course good news when looking at savings, that we're finally kind of back in a territory where you're actually getting some your money's worth basically, and it's not losing spending power just sitting on a bank account. So I think you'll be happy to hear that it will stay with us for a bit longer.
So even though, as I say, there's a bit of nervousness about base rates dropping and the market dropping, then as long as it kind of keeps pace with inflation, then there's positive return. One of the other questions that came through, as interest rates have been more attractive for a while now, there's also a concern that the tax allowance we have in the UK, so effectively for basic rate taxpayers, £1,000 before they can pay tax or need to pay tax, and £500 for high rate taxpayers. So any thoughts, Robyn, in terms of how people can kind of ensure they minimise that? And I suppose the one thing we need to refer to is there is quite a battleground for cash ISAs at the moment, and they've become increasingly attractive over the last 12 months. So first of all, any thoughts on the first point?
Yeah, I think it does link quite nicely onto the next question. I think if you know you're already paying tax on your savings or you're near to this limit on your personal savings allowance, it is worth considering a cash ISA, as the interest on these is always tax-free up to 20,000 per year. But typically the rates are lower on standard fixed rate deposits. And for easy access, it is usually lower. However, at the moment, as we're seeing kind of in articles, there's actually some really good easy access ISAs out there. So it's not something that we can avoid talking about. There are some deals out there for easy access ISAs being very competitive at the moment. But typically, ISAs are usually priced less competitively than your standard fixed. So in terms of best saving accounts there, if you're, as I said, paying tax, then it's worth considering an ISA. If you're not, then there's loads of options, obviously, with fixed that mean that typically you're going to get a higher rate and better return. The only thing there is, obviously, as we've touched on as a bit of a theme from some of these questions, is of course you can't then have access to those funds during that time. So it's really making sure that you can address how long you can afford to hold and have that money locked away to benefit from that higher rate. But easy access is a great option if you do need to get funds quickly and you want to have access to it and get a better rate than that's on your current account, typically. You can top up on these, you can withdraw. So it does mean that you have a lot more flexibility with an easy access account, but you have to know that the product is variable. So this does mean that your provider bank can change the rates at their discretion. So obviously, again, going back to the themes that we've mentioned throughout the webinar, if you can afford to lock in, it's a good time to do so at the moment.
Yeah, and again, I think there's a lot of kind of research around how much money is sitting in accounts that's paying next to nothing. And I find it amazing. There's hundreds of millions of pounds sitting in accounts paying 1% or less. So hopefully, if we all continue to push the message, then people do take the time to try and get their money working a little bit harder. As you say, the kind of question, what's the best savings account for me? It is really down to individual circumstances. One of our primary concerns is security, and I can fully understand that there's lots of media attention now across various devices. And Robyn, you talked earlier about the mobile app that we've got, and that's proving really popular. So first and foremost, there's a lot of content on our site. So there's kind of guides and around how you can protect yourself. But in terms of kind of Raisin, we adhere to the latest security standards. I mean, we have things like strong firewall, prevents unauthorized external access, multi-level encryption. While some of us find that a pain at times, you can understand the reason for it. We're there to protect our accounts and our money. And that's why, as I say, the password protection, when you've got an account, you access a secure environment to see the information about your account. And also, and Robyn, I think you referred to it earlier, the personal mailbox that we have with message encryption. So we certainly take security and the threat of that can come from fraud, scams, etc., very, very seriously. But it is imperative that, as I say, we all do our bit. And if you get the opportunity, check the guides and the content that we have on the site. And you should all know, but yeah, that's raisin.co.uk. The next one's somebody who's a pensioner and looking at a risk investment strategy against inflation. I think we've touched on a lot of this. I mean, first of all, of a pensionable age, your circumstances are different than, say, some of the younger customers that are building up to a pension. But is there anything in particular that either of you want to add to this?
I guess with the budget being a topic, obviously today, they did touch on it a little bit just to kind of mention some things that may affect some of our customers that are in the session today. So they did talk about state pension and how that will rise with average earnings going up to 4.1% in April. So for the full new tax date pension, this could be an expected increase of £230.30 a week. And if you're on the full old basic state pension, then that's expected to go up to around £176.45. So kind of these topics have been kind of obviously brought up quite a lot today, but also worth mentioning how they've also talked about the winter fuel payment being removed for a lot of pensioners. So it is important to check if you're eligible for pension credit. This is also just another way to kind of make the most of your money and just check if you're eligible for any other benefits as well.
And one of the questions I've got in front of me, looking at the other age range, that younger people are saying, how do I kind of start my savings? And I think generally what we say is that the budgeting process is important. We will face lots of challenges with kind of cost of living, and hopefully as inflation drops and interest rates drop, that will ease. But I think just getting into the good habits and maybe trying to budget where you save at the start of a month as opposed to trying to think what's left at the end. But as we've talked about, we have lots of attractive, easy access accounts with low opening balances required. So that's a good way to start. And even the same with a notice account, because as I say, it's not as straightforward to dip into that. The other point, which I know, Robyn, you talked about in your slides in terms of the FSCS protection, I still get very often asked, even by journalists, as why is that brand as safe as a high street brand that we've recognised? So is it worth investing in lesser well institutions? And they generally, not only sometimes, have better rates.
Yeah, so exactly. So I think as per the previous slide on the FSCS cover, it's trying to give you peace of mind, reassurance that the partners that we have on raisin.co.uk, you can benefit from higher rates than you might typically see on the high street, whilst having that comfort that you are protected by the FSCS or equivalent scheme in Europe. So if you want, obviously, if you're looking for the highest rate or trying to get the most out of your money, then it is worth having a look at some of our partners that you might not be as familiar with to benefit from those higher rates, particularly if they're not going to be around for much longer and we are trying to lock into those rates. It's definitely worth a look.
One of the questions here is, can we have more Sharia compliant partners, please? And I don't know in terms of where the question's actually coming from, but I think worth adding to that, I get involved in some of the business development aspects, and you saw earlier from Robyn's slides how many new partners brought on board. I would say that our pipeline is as healthy as it's ever been. There's so much demand from deposit-taking institutions to diversify, and as Raisin UK has become more recognised and established, then there's lots of kind of discussions on not only the existing partners and improving their relationship with ourselves, but also new ones. And what is interesting that rate is important, but as we see on a regular basis, there's quite a decent spread across different partners. So either people have maxed to the 85,000, or on top of that, the kind of brand or sector in which the partner in makes a difference. And that's why we've got building societies, credit unions, and lots of different banks, from UK challengers to Sharia. And if it is more from the ethical point of view, then you've got a choice that goes beyond just the product and the pricing. But anything that you want to add to that, Robyn?
Yeah, I think if it's Sharia something that you're particularly looking at, I think Raisin, we continue to grow with our partners that are currently Sharia. And actually, we do offer something in every product type. So there is a Sharia product within fixed term, the lower and the higher terms, and also within notice accounts. And we actually have one partner that's Sharia that has an easy access offering as well. So hopefully, there is something to cover each savings option if you are particularly looking for a Sharia institute.
One of the questions I've got here is the balance between investments and cash. We're not in a position to advise on the investments, but I think as a kind of general view on this, investments are very much medium long term, whereas from cash point of view, then that can affect you at different times. And obviously, as we said before, things like fixed term bonds, some of them are short term because you're actually saving for a specific outcome. But I think generally speaking, it's good practice to have a portfolio of products. So investments for medium long term and cash as well, both fixed and easy access. Again, I don't know whether, Robyn, there's anything or Jasmin you want to add to that?
No, just what you said. I think it's always good to have a healthy mix in your finances. So if you do have a longer term horizon that you can kind of invest in, for sure, I think going for investments is a very good addition to your savings portfolio and to your financial portfolio. But of course, we all need cash at some point in time. So that's why these bonds and also easy access accounts are quite an important part of portfolios.
Okay, well, thanks very much. I'm conscious of the time. Hopefully you've all found this evening very interesting. And the outlook, even though the likelihood is that interest rates will change, I think the the offers that we're going to get from our partners will continue to be competitive. At the end of the day, we have lots of providers that are all kind of looking for retail deposits. And that means that often the interest rates they're offering are artificially high. So, but if you do see an offer that you think is attractive, then they won't always be around forever. So if you do see something, then grab it whilst you can. I mentioned earlier that from time to time we carry out research projects. We've just completed one actually, and on the back of it, we've produced the comprehensive Great British Savings Report. Excuse me. You can access that through the website. So I think if you've got time, it'd be great to log on and have a look at that alongside all of the other content that we produce. But on behalf of myself, Robyn and Jasmin, I thank you again for your attendance this evening and enjoy the rest of the night. Thank you very much.